Right now, today, there are commercial real estate owners across this country thinking about their mortgage payments, their debt maturing, and their ability to refinance in a very alarming way. The rate that they borrowed at a few years ago, 3, maybe 4%, and the rate that they'd have to refinance at today, 6, 6.5, maybe 7, depending on the deal, just doesn't make the numbers pencil anymore. And here's what nobody's talking about right now. $797 billion in commercial real estate loans are maturing this year. And the owners who can't make the math work on their deals anymore, their debt and the returns that they are going to need in order to satisfy their lenders, to satisfy their investors, they're not going to be able to hold on to these properties. So they are going to become forced sellers, and they are going to sell to whoever is ready to capitalize on the opportunity. Now, the goal of all of this is to make that opportunity, when it presents itself, be something that you can capitalize on. And if you look at the TREP headlines of 700, almost $800 billion of debt maturing, that's some pretty big opportunity. And one of the most respected data firms in commercial real estate is not just projecting this, they have a very clear and concise calendar of when this debt is maturing. So here's what we're going to be covering today. I'm going to break down the CRE maturity wall, what it is, why it's hitting hardest right now in 2026, and exactly what does that mean for you and your ability to buy real estate at prices that haven't existed in over a decade. If you're somebody that has capital, has creative finance, seller finance, skills up your sleeve, this episode is going to be a great roadmap to give you an idea of where some of these windows and opportunities are going to present themselves. Let's get into it. Hey, what's going on, guys? Welcome back to another episode of Millionaire Mindcast. Okay, so let me give you the full picture here, because the media is either ignoring this story completely or they're making it sound like an apocalypse. But the reality is there's a lot of noise out there. It's somewhere in the middle. And it's actually one of the most interesting setups that I've seen in commercial real estate in my investing career. This is something that I've kind of been talking about for a while, since the post-COVID kind of financial boom with assets, with capital, and then obviously when we started to see the hikes and inflation going, this is going to create some ripple effects that we're going to see in a couple years. Well, fast forward now, we're here in a couple years. So here's how we got here. Back in 2020, 21, 22, money was basically free, right? The helicopter money, the Fed printed, a lot of capital injected at really low borrowing rates into the economy. A lot of people put it to work. Inflation, or assets inflated, values inflated, right? Revenues and all kinds of stuff went up. When you got the Fed having rates at near zero, it's a great thing if you're an investor and you want to leverage and put that money to work. And if you were a real estate operator or developer, you were borrowing at 3.5, maybe 4% on the high end. You were buying, multifamily buildings, office parks, industrial, hotel. I mean, pretty much any asset class, all of it. These were doing really, really well, but they were getting bought kind of at aggressive valuations, right? We had compressed cap rates, values were up. But guess what? The returns tied to these assets because of cheap debt was also up. You had cheap 5 to 7 year debt. And overall, if you're an investor and you're putting that money to work, life was good. Who would have thought, that things could change? Well, 2022 happened. The Fed started hiking rates in the face of rising inflation, some geopolitical tensions. 11 times in roughly 18 months, we saw a rate hike, one of the fastest tightening cycles in the history of the central bank. And a lot of real estate investors, just a lot of investors in general, weren't necessarily, one, ready for how that was going to play out as fast as it did, and two, more importantly, how that was going to impact them and their investors and their assets going forward. So suddenly, the 3% world was gone. Rates on new commercial real estate loans went from roughly, call it 4.25, 4.75, to on average of 6.25, almost overnight in terms of the refinancing environment. Now, think about what that means for someone who borrowed $20 million at 3.5% in 2021 on a 5-year loan. Really any asset, right? Multifamily, mobile home parks, industrial, you name it. You know, at those borrowing rates, it made a ton of sense. But not a lot of people factored in when it comes time to refinance their debt on that 5-year loan, what interest rates realistically are going to be at. Maybe a point higher, maybe 2 points higher if you're being aggressive. Well, no. We're looking at rates almost double what they locked in at. So their debt service just blew up significantly. Their property value in many markets has dropped 15 to 25%. And guess what? Their lender, they're not going to be as patient as they once were, like many were in the post-COVID era. So what happened between 2022 and 2025? Well, a strategy that many love to kind of live by, called extend and pretend. Lenders didn't want to foreclose on assets. They don't want to take them back, right? They're in the business of putting capital to work, not asset managing, and figuring out what to do with non-performing assets. So borrowers didn't want to sell at a loss. So they basically went to these lenders and they made handshake deals. Hey, let's extend the loan 12 months. Let's extend it maybe another 12 months. Let's just kick the can down the road and let's hope rates come down. Let's hope the market recovers. Let's hope inflation comes back in line. Let's just give ourselves a little bit more time. Let's just extend and pretend we're good for now. And they could do that. Now, the problem, the can has just run out of road to be kicked down. And according to TREP, one of the most respected data firms in commercial real estate, 79.7 or 797.1 billion in commercial real estate loans are coming due in 2026 alone. So to give you an idea, that's roughly 16% of the entire 5 trillion commercial real estate loan universe in a single year. And if you look at some of the data from MSCI, they show 60% of apartment loans originated in 2021 and 2022. They mature in the second half of this year, meaning the bulk of this hits between now and December, so the next few quarters. The extend and pretend era is officially coming to an end. So let's talk about where I want you to lean in. Where's this opportunity? Because this is where I believe the opportunity lives. And I want to be crystal clear about the difference between what's happening to over-leveraged owners and what it means for prepared investors. Because these are the seasons, right? And I'm not saying this is going to end up in some massive commercial real estate crash. There's a lot of obviously geopolitical and economic variables in this that could keep it stable, and we just see, some of this flush through the system. It could also lead to some bigger cracks. So time will tell, but what I do know is there's going to be opportunity in this window. So let's talk about what actually happens when a commercial real estate loan can't be refinanced. The owner really has 3 options. 1, they find a new equity partner to recapitalize the deal and buy down the loan, right? To bring more equity to the table, pay the lender off some money, and lower the amount of debt service they're paying on the debt that still remains on the property. So that's an option. But it's tough in times of capital crunches to get a bunch of people to just throw money at deals that already maybe having some financial pressures or trouble, right? A lot of people don't want to throw good money after bad. Now, 2, they restructure with the lender. So they go back to the bank, which means that oftentimes they're going to have to give up control. Maybe they're going to have to bring in mezzanine debt at expensive rates. They're going to have to squeeze down themselves and or their investors that are already in the deal, and they're going to have to take a haircut on their equity. Not ideal. Or 3, they're just going to have to sell. They're going to have to sell, and sometimes that's at a loss of investor capital, some, all. And when you're being forced to sell by a maturity date on a calendar, you're really no longer negotiating from a place of strength. The posture that you have at the negotiating table essentially just goes away completely. And guess what? People know that. Banks know that. Buyers know that. Your investors that you may be trying to bring in know that. And that's the buyer's market, moment. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple. Focus on first position, asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. So I want to talk about, what I've seen out there right now recently. I've seen many scenarios where this is exactly playing out. Really scenario 1, 2, and 3. And I want to give you, the numbers that really paint this picture. So in the first half of 2025 alone, lenders recorded nearly 150 commercial real estate foreclosures, which, isn't a massive number, but it's the highest mid-year total since 2014, just to give you some perspective. So 2/3 of those apartment foreclosures, they were loans from 2021 and 2022. The exact vintage of asset class and investor that MSCI says is hitting its maturity wall right now. So those were some of the early signs. And I think we're going to see a lot more of this in the second half of 2026. Now, meanwhile, total distressed commercial real estate volume hit $126.6 billion in Q3 of 2025. That's up 18% year over year. And multifamily specifically accounted for $22.8 billion of that distress. And it seems to be continuing to tick up and growing. So here's the analogy I want you to sit with. Think about a game of musical chairs. From 2020 to 2022, every time the music played, every time a loan came due, there was always a chair available to sit down in. You had cheap refinancing, you had rising valuations, you had eager lenders to put capital to work, and everyone found a seat. Well, now the music is still playing, but there are much fewer chairs to sit in. Refinancing is extremely expensive right now. Property values in many sectors are down. Revenues are down, expenses are up based on property taxes and insurance squeezing down NOI, which compresses value. And so that's not a really good storm for anybody that's trying to refinance. And the lenders who handed out chairs freely for 3 years, well, guess what? They're like, let's take our money back. You know what? Let's just bring it back in-house and let's see and, recalibrate with a lot of the uncertainty that we see in the market right now. The people left standing when the music stops are being forced to sell at prices they would never have accepted 12 months ago. So this is where, if you're a smart buyer and you've been patiently waiting, this is where I believe that discipline is going to pay off. And this is really what a lot of smart money has been doing, right? You keep hearing about capital on the sidelines, the war chest and the dry powder. Well, these are the times that they really start to look at where the distress and the opportunities are in these microclimates of the real estate cycle within certain asset classes. Now, I want to give you the contrarian side of this too, because not every market analyst is saying that this is a crisis. Some experts at Connect Commercial Real Estate point out that lenders and borrowers are still finding creative workout structures. So that's still something that's on the table. They're performing tranches, preferred equity insertions, partial refinances on the capital stack. There's a lot of different ways that you can work your way out of some of these challenging times, and the smart operators are doing that. The average commercial real estate delinquency rate ticked down slightly to 1.52% in Q2 of 2025. So the whole market is not just blowing up at once. This is not 2008 all over again. The key difference the experts keep making is this. Back then, you had distressed properties. Now you have distressed sellers, really because of their capital stacks. Owners whose capital structures are broken, but their underlying assets are actually performing just fine. So the distinction, in my opinion, matters enormously because that means you can buy a fundamentally good asset right now at a distressed price, not a fundamentally broken building that is, in disrepair or in, completely crumbling from the operational or foundational level. So that's actually, in my opinion, a much better risk to reward trade and investment if you think about it. So let's talk about, some of the prior foreclosure data, the 126.6 billion in distressed volume. You've got 150 foreclosures in the first half of 2025. You've got more ticking up in 2026. And the bigger wave really is going to play out here in Q3, Q4. So this is more of just studying the debt calendar and thinking about as debt gets deployed and debt becomes due, how does that flush through the system based on the resources and the opportunities or lack thereof that are available in the marketplace? And how does this impact sellers? So this extend and pretend, this, hold out for values and rates to, rates to drop and values to come back to where many sellers got used to them being in kind of the post-COVID pump. That music and that opportunity is running out. This is the nuance that separates the panic narrative from the opportunity narrative. And I still think a lot of assets in the market are fine. It's the capital stack that is broken. And we knew it was going to be broken and have pressure unless some of that pressure got alleviated. Now you know why Trump has been pushing, too late Jerome Powell to lower interest rates. It's because the pressure he knows and many of the people that are leading in the real estate space and deciding on policy around that know that they're at the mercy of the Fed releasing some of this financial pressure that has been mounting in the real estate market on the single family and the commercial side. So that's a very different problem than what we saw in, call it the, great financial crisis. And it's a solvable one if you're a buyer. Distressed office sales, for example, hit 4.3 billion in 2025. Up 31% from 2024. Institutional buyers are coming in below replacement cost and they're upgrading these assets, they're repurposing them, they're recalibrating the use of them, right? But they're getting great assets, fundamentally great assets in great locations, but because of the capital stacks at very discounted prices. And if the institutions are doing this, the question is where can you and I, right, as individual investors play at a similar level or with a similar strategy, just at your scale, right? Maybe we're not buying skyscrapers and $200, $300, $400 million assets, but we can still do this in certain, price points, in certain asset classes, in certain markets across the country. And this is where I think you got to lean in and really be aware of this window of time. So here's what I actually think is happening, and what most investors are completely missing. Everyone is waiting for the perfect signal. They want the rate cut to happen. They want prices to be clearly marked down. They want the headlines to scream, buy now. Come and get me before they actually move. But here's the thing. By the time that headline runs, it's already too late. Those deals have already been scooped up. The institutions already own them. The mom and pop investor already found that, the one that was at least being proactive and getting in front of some of these headlines. The 250 billion in dry powder that private real estate funds have been sitting on in North America right now. You got the Blackstones, the Oak Trees, Brookfields, these big institutional funds. They are not waiting for certainty. They are already circling. They're already putting money to work, right? Oak Tree's head of real estate literally said, and I'm quoting, "We could be on the precipice of one of the most significant real estate distressed investment cycles of the last 40 years. When the smartest money in the world is saying that, something like that publicly, That's not noise. That's a signal. That's something that we should be paying attention to. I don't have all the data that they have access to. I don't have all the resources, the capital, the confidence, the insights that they do. And so, one of the best things that we can do is keep our ears to the pulse of what the big boys and the big girls are doing and where they're positioning.
Here's the thing about most investors right now. They're consuming a ton of content, but they're not actually more informed. They're reading all the headlines, they're watching the tickers, they're following all the noise that mainstream media wants you to follow. And at the end of the day, you're still not informed on what it actually means for your deals, for your portfolio, or for your next move. So if you're listening to this right now, I don't think that's you. I think that you actually want to understand what's happening, how it impacts your investments, what you should be doing going forward, what you shouldn't be, and not just reading about it. That's why I decided to build the Wealth Intelligence Brief, a newsletter sent to you 3 times a week directly to your inbox where we cut through the noise. We send you the macro data, the real estate intel, crypto signals, and all the unfiltered takes in 5 minutes or less for free. Eliminate the noise, keep the edge. Sign up by texting the word WIB to 844-447-1555. That's WIB to 844-447-1555.
Now, I want to give you my honest read on where the real estate opportunity sits because it's not evenly distributed across all commercial real estate asset classes, right? There's based on the cycle, the market, there's a lot of variables here that there are certain bull opportunities in certain asset classes at certain times, and there are certain ones that I still wouldn't even look at or touch. And again, this depends on your capital goals and your strategy and your overall ability to capitalize on these things. As we all know, office is still the most distressed. And it's honestly the most complex because the world of office and how businesses and workplace environments operate, it's shifted. CMBS office delinquency rates hit 12.34% in January of 26. That's not for the faint of heart. You better be bold if you're going to get into those types of assets. And honestly, you got to do it at scale, right? Which makes it challenging for mom and pops. It's a turnaround play. It requires specialized expertise. And if you don't understand lease structures or you don't have the tenant improvement capital or some of the rezoning things that you need to work through or just patient money, you can get destroyed, right? So I would personally leave that to the deep specialists, but hey, you're more than welcome to do so. Now, multifamily, this is where I think there's some big opportunity and probably going to be the biggest flush of debt and distress without necessarily saying it's going to completely crumble multifamily values because I do think they're still very strong and sturdy. Um, this is at least where I'm paying attention because the fundamentals of the asset class are strong. People are always going to need a place to live. Shelter is a core need. Home ownership affordability is obviously at an all-time low. Um, the buy versus rent premium is over 100%, but the 2021, 22 vintage loans, they are coming due with owners who are over leveraged at peak pricing. And there's a lot of them. I know you've heard of syndications and investors who bought at that time frame and had all these rosy, beautiful pro formas and upside to be captured. And guess what? They bought at the top, right? So this creates the exact setup that we're talking about here. Good asset, broken capital structure, and there's going to be a motivated seller behind it. That is a wealth building moment hiding in a distressed cycle. The investors who are going to win the next 5 years aren't the ones who built the best spreadsheet or had the best marketing deck and could raise all the capital. They're the ones who built the relationships with the lenders, with the special servicers, with the brokers that have good relationships with their investors, have deal flow coming in. And those are going to be the ones that when those forced sales hit the open market, they're going to be able to capitalize. Because by the time it's on CoStar or LoopNet with a shiny marketing package, you're already kind of paying market value or if not higher. You're competing with, all these other buyers and the price is already recovered. And you want to be the first in the room before that happens, as we know, right? So thinking about, how do I take this information and what do I actually do with it? So here's just some quick moves to think about to arm you to capitalize on this season. Move one is get in front of the deal flow early. The best distressed deals never hit the public market, right? They get sold quietly through lender relationships, special servicers, connected brokers, maybe conversation with owners. So if you're serious about playing this cycle, your job right now is to build or deepen those relationships. Don't get lazy right now in your patience of trying to find a deal. Don't get lazy in doing the things that will lead you to the success, which is relationship building, right? Connecting dots, adding value. So call the broker, right? Call the special servicer, go to the events, still build that momentum in the areas that will matter no matter what kind of season we're in. Because at the end of the day, you want to be the first call, not the 20th. Now, move to underwrite at today's rates, not yesterday's dreams. And I would even go to say underrate at a little bit higher of a rate. We still don't know with, Kevin Warsh coming in with this Iran conflict, with oil and energy, with inflation maybe being sticky. There's a lot of things that I don't think we're going to see rate hikes, but never say never. This is where investors get burned. They see a distressed price, they get excited, but they're still underwriting to a rate environment that doesn't exist or isn't going to be that anytime soon. So your deals need to work at 6, 7%, plus debt yield costs today, full stop. No negotiating on that. Just be safe because you want to win long term. And if you're counting on rate cuts to make the deal pencil, you know, that hopium is setting you up for potential failure going forward. Build your margin at today's cost of capital, and anything above and beyond that, those safety nets and buffers in place, you're going to win. It's going to be icing on the cake. Now, move number 3 is focus on the asset classes with broken capital structures, not broken fundamentals. The sweet spot I keep coming back to is assets with strong occupancy, solid market dynamics, good locations, good market demographics that are owned by over leveraged sponsors who simply just can't make the refinance pencil. Those are the deals that are going to be out there right now and coming forward. Your job is to find those motivated sellers, those brokers, those relationships that can put you in front of those opportunities. So, bottom line, all I'm saying, almost $800 billion in commercial real estate debt matures this year. The extend and pretend era is done. It's gone. And while it may be available for a select few for the masses, it's over. So motivated sellers are going to be entering the market. I think we're going to see more people coming off their price and the terms that they had to have or had to see. And that's where those opportunities are going to lie. And the smartest institutional capital is already positioning and taking advantage of it. The question is whether you're going to be right there too. I want to see so many mom and pop investors take advantage of this season and this cycle because they don't come around very often. And when, you get past them in hindsight, you're like, man, I should have bought more. I should have done more of those opportunities. I should have taken a little bit more risk. So if you found today's episode valuable and you're new to the show, don't forget to hit subscribe. We're going to continue building wealth in all facets of the market. And that is obviously through commercial real estate, my core focus, of course, in crypto and stocks, and continue to keep a pulse on all the economic data and geopolitical data that impacts the investment decisions that you're making, not only today, but going forward. So with that being said, as always, appreciate you guys tuning in. Keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.